start the broadcast as well. ठीक है? I'll mute myself here before.
ठीक है, ठीक. Hello. 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 Hi everyone. This is Devang from ArthVeda, and I would like to welcome everybody from Mitras for this particular webinar, which we are specially organizing for Mitras. And I look after the sales and distribution. I head this division, and I have Mr. Dr. Vikas Gupta with us, who would be presenting us our value investing philosophy of ArthVeda STAR. I would like to welcome Dr. Vikas.
Hello.
And he will go ahead with this particular presentation. And I would think everybody have logged in, but I'll just request Dr. Vikas to start the presentation after about a minute. So in case if somebody else is joining in, can just join before we start the presentation. So Dr. Vikas, welcome, and I welcome all the participants from Mitras also, and maybe Dr. Vikas will start this presentation in about a minute.
Participants from Mitras Financials and the clientele. I can still see more people are just joining, so I just saw several people.
The broadcast is now starting. All attendees are in listen-only mode.
Yeah, Vikas, continue.
Okay. Okay, now we can start. I think all the attendees are present. Okay. We'll focus on what is value investing in the context of Indian real estate. That's what is the topic for the day. And what we have done here is taken the principles of value investing, which are very well known and have given spectacular returns in the listed equity space, and we have tried to absorb that philosophy and applied it to the alternative investment world, probably for the first time in India and probably across the world. So what is value investing exactly? Value investing is an extremely risk-averse philosophy which is applied to risky investment classes. So it sounds paradoxical that you hold a risk-averse philosophy while participating or investing in risky assets. So the logic behind that is risky assets give high returns, could give potentially high returns, but also they have potential to destroy your wealth, and which means they are risky. That is why you need to actually get this kind of a philosophy which is risk averse, which does not like risk, while investing in risky assets. So in that, if you can apply that philosophy properly, you are able to extract the high returns which these so-called risky assets have while reducing your risks. So we'll look at it, how we have done this. Okay. So you can see on the left side these blue boxes which show you the core concept of how a value investing philosophy is applied. So first you start with risk elimination. Okay. So whatever risk elimination, you can see the red spot. So whatever risks you can eliminate in this asset class. We have chosen the Indian real estate as an asset class for ArthVeda STAR. So first we look at it and we try to see what are the asset classes within real estate, Indian real estate, which are risky and where we can eliminate the risk. Next you go and look at where can you mitigate or minimize or reduce the risk. You will end up having to still address some risks which cannot be mitigated, in which case you try to see whether they can be managed or controlled. Once you have taken all these steps of elimination, mitigation and management or control, then you focus on maximizing your returns. This is how you apply the value investing philosophy. So you have first taken care of your downside. that you've made it difficult to lose capital. Once you made it difficult to lose capital, then you start focusing on how I can get the maximum returns. Okay. Now we'll go through this step by step from elimination, mitigation, management, and maximization. Okay. Now why ArthVeda is the right company to give you the real estate funds is because our group has been in housing finance for nearly 3 decades now. Dewan Housing Finance Limited, you might have heard of, which is the third largest housing finance company in India. So there is a lot of strength and presence across small Indian towns like tier 2, tier 3 cities, and the focus has been in middle income for a very long time across around 200 odd locations in India. We have a very strong team in this. We have good services in terms of transparency, etc. Okay. So getting back to the risk elimination portion, we track classes which are saturated. Then mitigation, there are 2 other 7, and then you do risk management across the life cycle of a typical investment. And then how do we do the return? What we've done is we are addressing the risks, etc., inherent in directly investing in real estate. On the right hand column, you can see that. Okay, you can see this column. And what are the typical risks when you do direct investment in real estate? You're concentrated in a single project. Okay, and in fact, a single unit in a single project from a single developer in a single location. Okay, you have to rely on whatever expertise you personally have. Okay, and the kind of knowledge. Many people might even have expertise, but probably they don't have enough time and to spend on gathering the kind of knowledge which is required. And returns are mostly dependent on price appreciation. Okay. The other kind of return is dependent on rental yields. I'll just quickly across most cities in India today, the is about once the house using a home loan. So you are actually losing money on each investment continuously. Okay, and that to 3/4 of the outgo is all loss. Okay, now all of that has to be made up only by capital gains, which is where your price appreciation comes up. So the price appreciation has to pay for all your interest costs and then some, and only then you start getting into positive territory. So the risks are high and the returns are relatively low or actually quite low. Although during certain periods of bullishness in the price appreciation, it looks like you're making a lot of money. Okay. Now as compared to that, look at ArthVeda STAR as a fund. There you will get high diversification due to multiple projects. Now ArthVeda STAR is focused on about 16 cities, tier 2 and tier 3 cities, and around 30 plus projects. So you are highly diversified across multiple projects in each city, multiple developers, projects, locations. Okay, the managers are experts. They have gained a lot of knowledge and expertise in this business, and that has been applied in the choice of those cities as well as choice of those developers and those projects. The target IRR is independent of price appreciation. I'll run you through this logic again, but just wait for me. So we are able to combine very low risk while we are attracting quite high returns, much higher than price appreciation can ever deliver. Okay, just as a quick illustration, we'll come back to this illustration again, but typically if we are selling 1 square foot of space Okay, ArthVeda STAR invests rupees 450 per square feet, and where the total cost of the project is 1650. This includes the construction costs, etc. And it will sell it at something like 2500 rupees. Now an investor who purchases this unit from the developer might be getting a discount of around 500 rupees. So if this is targeted to sell at 2500, you might be able to buy it at 2000. So this is the best a developer can give you. Okay, and so your return over this is about 25%. While you can see what kind of return the ArthVeda STAR investor will get, it's around slightly more than 40% IRR. Means 40% compounded annually are there in real estate. You can broadly divide into 5 segments: retail or mall space, commercial or office space, industrial or warehousing, hotels, SEZs or others, and then residential. Out of all of this, retail and mall space and commercial and office space are typical cyclical industry, okay, where you need to invest large amount of capital, which is locked in for 3 to 4 years at least, and during that period there is that risk of oversupply entering, because what happens is the retail or mall rentals or office rentals are very high. So somebody spots that opportunity that yes, this is a very high yielding asset class, and they start looking for a large piece of land to create a mall or an office space. Once they have taken that piece of land, that acquisition itself takes some time, and then you have to get all the approvals and all in place. And by the time you start, and you'll realize that many other people have done the same calculation, and they have also acquired large pieces of lands and gotten approvals for the malls, and now suddenly their malls are in oversupply. Now that doesn't mean you can stop. You have to finish the mall because otherwise all your capital is going to go away. So you finish the mall, and around the same time in the same year 5 to 6 other projects, and there is a huge oversupply, and that oversupply will last for several years before all of the extra volume is absorbed, and then the yields will start going up. So this is a typical cyclical industry and hence risky, the mall space and the office space. Now industrial and hotels etc. also face the same kind of problem of cyclicality, but there is an additional problem of political risk. So government will announce this FDI policy. Now this has been going around for 10 years now. FDI policy, single GST, etc. And when that happens, the land prices of potential warehousing or hotel locations start going up. While actually, since government has not actually implemented those decisions, the sale price cannot be realized. Okay, so in addition to the cyclicality, these two have the political risk in abundance. Out of all of these, to us, the residential asset class in real estate is the safest. So we focus on that. Okay. Now within residential office, space, again we slice it into 4 segments. The high income, which is again into 2 segments, which is luxury segment and premium segment. Then the middle income segment and the low income segment. Now in the luxury segment, the typical thing is that the potential buyers are all already living in a nice house. Okay, they're all living in luxury housing, and they are facing they have a lot of liquidity, and then they enter all these new luxury housing projects as investors. So typically in luxury housing there's a lot of investor demand, and they're hoping to sell to other luxury buyers. Next is premium, where the mix is still heavily biased on investors, but yes, there is a significant genuine demand happening. As you come to middle income, there is a lot of genuine consumer demand. So people are buying, taking a loan and buying these houses to live in them for long periods of time. Okay, and the demand is extremely high compared to the supply which is happening. And next is low income, where the demand is even higher, but this requires very specialized developers to supply this. and hence this is a specialist asset class. While middle income is possible, middle income housing is possible to supply by normal developers using conventional technology. So we are focusing on this middle income segment, which is highly consumption driven. Okay, so where it is driven by the rising middle class, the rising per capita income of these people, the increase in nuclearization of families from joint family style, and there is a consistent replacement demand around every 10 or 12 years. Now we'll move on to the next slide, which will focus on the which are the viable cities and which are the unviable locations. So if you see, we have divided broadly, you can divide into metros and tier 2, tier 3 cities. Okay. In the metros, we normally count Mumbai, Delhi and Bangalore, or Delhi I mean NCR. So Mumbai, Delhi and NCR are counted as metros for real estate purpose because they account for about 60 to 70% of Indian real estate by value in rupee terms. In volumes, of course, the volumes are higher in tier 2, tier 3 cities and metro outskirts. So within these two, we think metros have a huge oversupply, okay, in the premium and luxury segments, while there is a huge unsatisfied demand in middle income segment, but it's not economically viable to provide that middle income housing in metros because of the high land prices. But in tier 2, tier 3 cities, the demand is also high and it is highly viable to provide these middle income houses. Just to see happens because the recent global downturn. So 2008, 2009, the global financial crisis, which is a once in a century kind of event. So we just tried to look what was the impact, and you can see that on the left side is the volumes, Mumbai housing volumes, okay, sales volumes. So that dropped from 2007, 2008 to 2008, 2009 by nearly 40% year on year. So you can see that the Mumbai market crashed by nearly 40% in terms of volumes in that year. If you take the quarter on quarter in the last quarter, March 08 to March 09, that's probably 99% drop. Okay. Now in the same period, you will see that Dewan housing, this blue line is Dewan housing's figures. So Dewan housing grew in terms of loans by nearly 30% during the same period. So the worst downturn, once in a century kind of event, and Dewan housing was growing. And this is true for most housing finance companies. So somebody somewhere in India, where much larger number of people were still buying houses as compared to previous years. And Dewan housing has exposure to Mumbai real estate. Nearly 20 to 25% of its loan book is in Mumbai. Despite that, nothing happening in that section, still overall book grew by 30-40%. So that shows that there are these other smaller tier 2, tier 3 cities which are driven by local economic factors and not by the national real estate factor or the global financial situation, and they kept growing. Okay. So that strengthens our case for going in for tier 2, tier 3 cities. Okay. Now continuing looking at trying to understand metro market properly, we can see that in the last 5 years, from 2007 to 2012, in Mumbai, the number of houses sold is, this is the sales over last 5 years. Okay, 2.25 lakh houses have been sold in Mumbai for a price of 1 crore or more. Okay, average price of more than 1 crore. Now, who can afford a price of more than 1 crore? Someone earning more than 20 lakhs per annum. Households earning more than 20 lakhs per annum. Now, if you see our estimate of the cumulative demand of the overall bracket in Mumbai, households in Mumbai who can earn more than 20 lakh is about 2.5 lakh households. So even if there was no supply before 2007, if all the housing was created in Mumbai after 2007, still only 25,000 households are left to buy premium housing, right, 1 crore or above. But if you see the inventory right now in Mumbai is more than 100,000 houses. So this is extreme oversupply in the premium space. and I'm not even looking at the oversupply in luxury, which is even more. Okay, so we come to the conclusion that we have to focus on middle income housing in tier 2 and tier 3 cities and metro outskirts. Okay, so this is all fine. It's a great hypothesis. We said now let's start understanding. So far so good. Now let's start proving this case, and that's where we started out with a search for non-metro cities. Now since you want to eliminate the entry valuation risk. Entry valuation risk is what you pay for in a project, and what you pay for typically is the land price. So when you eliminate the entry valuation risk, you have to go to smaller cities. So, but now you want to also eliminate the liquidity risk. So if you create a supply of houses, will they be sold? Okay. So you have to concentrate on larger cities, otherwise the overall demand might be too little. So we took the cutoff of 8.5 lakhs based on 2001 census, and we got about 60 odd cities. Okay. From those cities, then we looked for cities where there was high unsatisfied demand for middle income housing. How did we find that out? First, we got data from Indicus Analytics and RBI on the various slices. So we divided the segments into 3 segments. One is the higher income bracket, which we termed as rupees 10 lakh per household or above per annum. Next is rupees 5 to 10 lakh bracket, which is the middle income segment, and lower than that is the low income segment, which is below 5 lakh rupees per household per annum. And within those segments, we looked at what was the housing credit given in the last several years by RBI. So RBI gives you data on the number of home loans given and the value of those home loans, etc. So based on that demand, we estimated the overall demand in the city for middle income housing based on the middle income segment population, and then we eliminated the number of loans given in the last few years, because those people had already bought a house recently, so they were not going to be in the market for another house in the next several years. So whatever was the remaining demand was called the unsatisfied demand, and we ranked the cities on high unsatisfied demand. Okay, so this eliminates your exit risk reduction, because if there is huge unsatisfied demand, you will be able to sell your houses as long as they are priced correctly. Okay, and what is the correct price for a middle income house? Since they are earning 5 to 10 lakh rupees per annum, they can afford a house anywhere between 15 lakhs to 40 lakhs. Okay, by financing through a home loan. The typical value of these houses will be 20 to 25 lakhs. So now you start looking at maximizing your returns. So which are the cities with high buying power? Again, RBI comes to the rescue, because RBI is able to give you information on savings and term deposits. Now if you do the savings and term deposits per capita of the middle and higher income bracket, you will find out cities which are more affluent or which have higher buying power. So that again eliminates your price risk. Not only that, it in fact puts a pressure on price increase. So you start getting return maximization. Again, you look at cities with high growth rate. So when you compare the growth in population over the whole decade of cities, you will find out that some cities grew much faster than the national average of about 2%. And so they grew at around 3.5 to 4% or higher. What that means is there is some kind of an economic engine at work in that town, which is why people are migrating to that city. Okay, so that again puts a upward pressure on the price, and your return maximization starts happening. So far so good. So out of 60 odd cities, we were able to rank them according to these parameters. And then we said, now we still don't know certain things, which is that what is happening in those cities. So with the help of our branches, we went to 30 odd cities out of the top ranked cities out of these 60, where we created 5 teams of 2 members each to survey these cities. Okay, and in these cities we wanted to find out what was with the DHFL branch managers. We arranged meetings with some of the top developers, reputed developers who DHFL had already worked with successfully, and we went and found out what are the land prices, which micro markets are good in terms of middle income housing, what are the land prices in those places, what are the sales prices, what kind of amenities people want, what kind of villas, 2 BHKs, 3 BHKs, what is preferred, what it would cost to do that construction, how many months it would take to sell these houses out. So a typical project, we understood a typical project and what kind of returns can be made out of that project. Okay, since you have all the things like land price and sales price and costs and the duration, you have ample information to estimate the expected returns. Okay, then we cross-check this with landowners, lawyers, brokers, valuers, etc. And we were able to get a very good understanding of which are the viable cities, and we signed letter of intents with a lot of these developers so that we could invest in certain projects which made sense to us. Okay, so this is how we went about selecting, and from these 30 cities we selected the 12 best cities. Okay, and in addition we had 4 metro outskirts, which is Mumbai, Bangalore, Pune, Hyderabad and Chennai outskirts. So these were the other locations which we already had very good experience from our previous fund. Okay, where we got excellent returns on these, ranging from 20 to 45% IRR. So this is how we selected the cities, 16 odd cities, and that's how we created this fund. Further, I could go into each deal level how we do the risk mitigation, but broadly, basically you do a preliminary assessment of what kind of returns you will get. Okay, if the returns look promising, much more than our targeted returns, which is about 30% returns, we start doing the detailed due diligence, where you carry out whether the starting from the legal due diligence, okay, which basically is whether the land is owned properly. Next is the technical due diligence, where the idea is to understand what kind of FSI can be created on that based on the town planning permissions. Next is commercial or marketing due diligence, where you understand what kind of selling prices prevail, as well as what is the sales velocity. So how many apartments can be sold per month. Okay, and finally you put all of this together into a financial due diligence, where you understand what are the costs, etc., and based on that what is the estimated returns. So even if the costs go up by 10%, 15%, etc., due to inflation, even if the sales price goes down because of various economic factors, still is your IRR robust? How safe is that? Okay, once all of that is estimated, then you are able to estimate the intrinsic value based on conservative estimate, and then you offer a deal which is got a discount to the intrinsic value. If the developer accepts the terms, then you execute the deal, and there is a continuous monitoring. Now again, when we say continuous monitoring, each project is housed in an SPV. In a special purpose investment is isolated from the others. Within each investment, you have something called a main account and an operating account. All the capital flows in, all the sales are received in the main account, and then the money is internal auditor sitting at each site in each project, providing us monthly reports. Our investment managers can see the banking transactions on a daily basis. Our construction due diligence can monitor the construction of the project based on the budgets. We get a monthly MIS on the sales as well as on the construction progress. The DHFL local branch manager and there is a technical officer employed at the local branch who will provide the monthly photographs on the construction progress. So this is how we keep complete control of the project and maintain the safety. Okay. Now also look at the model which I promised you that I would come back to it again. So this is how your sales model in each project is very, very different from buying a house and hoping for a price appreciation. You can see that if your targeted price of 2,500 is there, assuming that even from this targeted price of about 2,500, where you get a 42% IRR, let's say the price drops to 2,250, that's a 10% drop. You're still at 30%, 32% kind of IRR. If it drops further, to 2000, you're still at 21% IRR. If it drops all the way nearly 35% to 1750, you're still at a 7% IRR. Okay. Even if there is a delay, so you get the 2500 price, but you get it over 4 years, you're still at 30% IRR. If you get it at 5 years, you're still above 20% IRR. So you can see that how resilient your IRR is. As opposed to this, if you had bought a house, let's say at 20 to 50 at a discount from the developer, and you hope for price appreciation, as soon as the price dropped even 1 rupee below 20 to 50, you would be at a loss of capital. Okay. So this is the difference in the model. Okay. Here you can see those numbers, how those things come about on this screen. Why it happens. Okay. Typical equity goes into the developed land and approval costs. So if we maintain the land price somewhere for illustrative purpose at 350 rupees per square feet and approval costs are about 100 rupees per square feet, this is where your equity will be at 450 rupees. Okay. Construction costs of 1000 rupees. Interest on construction finance for 50 rupees, and this is marketing and sales costs, which is about 150 rupees. So total cost is 1650, out of which only 450 is equity, and your profit is 850 rupees when you target a price of 2500. So on 450 rupees, at the end of 2.5 or 3 years, targeted duration of the project, you get your 850 back plus your 450 back. So it's 450 becomes 1300. So nearly 3 times over a 2.5 to 3 year period. And that's how you get this kind of returns. Okay. Now if the price goes above 2500, your IRRs are really, really high. Okay. So I'm not getting into that. I just want to show you this portion where even if the price drops, this is what we are talking about. Okay. Yeah, we can go to these other slides, but I think broadly I have covered what I wanted to say for today, and now I would like to take questions actually. Yeah, Devang? Hello? Hello?
Hello. Yeah, thanks. Because thanks for the presentation. I think we have covered the core points which we wanted to cover in the presentation, as if why we have selected real estate, within real estate why middle income, and within middle income why tier 2, tier 3 cities, and our strategy of value investing, which we have taken, that we won't be investing in more than land and approvals, which would be more than 20% of the sales price. I think that strategy has also been discussed quite well. So I would request all the participants of Mitras, in case if they have any questions, they can write the questions in the box which is available on your screen, or can raise your hand. Then maybe we can get you connected and make you ask the question to Vikas. So any one of you, we invite you to raise your hand or write down your questions, which will be forwarded to the presenter, that's Vikas, and he will revert back to you on those questions. Lalit, have you got any questions?
I think somebody has asked a question, or how are the taxes calculated on the returns?
Okay.
So I'll take that question. the taxes are calculated. It will be basically the way we invest is a very thin layer of equity, and we use another equity-like instrument called the OFCD, which is optionally fully convertible debentures. So the majority of the investment goes in as OFCD. The advantage of a OFCD is that from a private limited company, you cannot extract the authorized capital out, the invested capital out, but you can easily redeem OFCDs without a very elaborate procedure. Okay, so that is the first advantage. Second is it's an extremely tax efficient instrument, because whatever is the redemption value, whatever is the gain, is treated as a capital gain for the investor. So you are exposed only to 10% or lower taxes. Okay, while whatever is the outgo on that premium is for the private limited or the SPV, it is taken as an interest cost, and hence it is taken out as a expenses. Okay, so it's a highly tax efficient structure, and you will face either a long-term capital gains of 10% or lower. Hope that answers the question. Santosh? Yeah, okay. Now Mr. Srinivas has asked a question on when is the fund closing, what is the time frame to fully invest. We are targeting the fund to close in a month or maximum 2 months, and the time frame for fully investment is going to be 6 months from the final closing. As we have given a drawdown schedule for people investing larger amounts, they can avail of a drawdown schedule where 20% is committed upfront, contributed upfront, and then 40% comes in 3 months later, and 40 more percent is 3 more months later. So that's a total period of 6 months for commitment, and around that time is when we will be fully invested. Okay, Varun has asked a question: what would be the advantage for a developer to go with funding from ArthVeda? Okay, wouldn't it be better off taking bank or alternative funding? Varun, while the developer can go for bank funding, he can do it for construction finance. But for acquiring land, RBI does not allow banks or housing finance companies to give money to buy land. Okay, and at the approval stage. So that's which is where the developer's equity is supposed to go. So that's why they're partnering with us, because they would have a limited set of equity. Okay, so normally if they are developing 2 to 3 projects with their own personal equity or through their network of friends and family, with our partnership they can go for 4 to 5 projects. I hope that answers the. Yeah. One more question is there from Priyanka. Could you please give a sense of the cities that you would be looking at, other than the cities like Pune and Hyderabad? Yeah, Priyanka, we have given the whole exact list of cities in our PowerPoint presentation. But I'll just show it to you. Just a minute. I'll just show it to you. So here you can see the kind of cities we are talking about, starting from Raipur, Nasik, Nagpur, Visakhapatnam, Lucknow, Vijayawada, Guntur, Coimbatore, Jaipur, Ahmedabad, Vadodara, Rajkot. So besides Pune, Hyderabad, Chennai, Bangalore, Mumbai outskirts, these are the other cities we are talking about. Okay, so you'll get a sense of the kind of cities. Okay, Swaroop has asked, can we hear something about past performances? Let's say starting 2008. Yeah, I would be happy to give that information. Okay, we'll just go to the presentation here, and we'll have a look at the past performance. Okay, this is now you can see our past performance on the screen, and you can see that out of our past, we had raised a 101 crore fund from between 2006 and 7, and that was invested in 13 projects across these cities like Hyderabad, Secunderabad, Bangalore, Pune, Chennai, etc. And this is the kind of returns we have realized on our 6 exits, which is ranging from 20%, which is the lowest, to 45%, and most of them are nearing 30%, 29, 30%. Okay, and the remaining 7 projects which we have still invested in, they are valued. I'll give you some more numbers. So we had invested 101 crores. So far we have returned 34 crores of profits, as well as 8 crores of capital back to investors. So that's 42 crores out of 101 crores back. Remaining 93 crores of capital is today. These 7 projects are valued at more than 190 crores. So it is twice the investment value. So we will end up with the overall IRR for the fund from 2007 to 2014, it was a 7-year fund. Okay. So during that period, we will have ended up with at least 25 to 26% IRR, despite the kind of challenges we know we went through during that. Okay. Varun has asked another question on how are you covering the corporate governance risk of the developer. So for that, as we said, we do a which is visible to us and which requires a signature from our side to extract money out of it. The only account in which he can operate is called the operating account, where as per quarterly budgets, our team releases money into his account, and then it's reconciled on a monthly basis with the tally report which comes from the internal auditor to us, the monthly accounts, as well as it's tallied with the actual progress on the construction side. So we are able to control the whole project very, very carefully. So that's how we reduce the corporate governance. Anu is asked, can you tell the nature of the investment in the ventures, equity or debt? Anu, primarily we have equity. As I said, we use an instrument called OFCD, which is equity-like, okay, and which gives you equity returns. However, in a case to case, 1 or 2 cases, we could structure things as debt when people are ready to give us very high returns on a fixed term basis. Okay, another question is, how will you keep investors informed about the progress in terms of investments? We would be giving out quarterly reports, okay. In the quarterly reports, we would be giving you what is the sales progress, what is the construction progress, what is the valuation, most recent valuation, and on a monthly basis, we would be putting the detailed MIS on sales for each project and photographs of the construction of the project on the website, which will be accessible to the investors using a login. Okay. Further, AIR is also going to do rating on each project, and you will be able to see those ratings also, at least on an annual basis. Okay. Hope that satisfies. Okay. What is the significance of hurdle rate of 12%? Okay, the significance comes in because we are going to do profit sharing with you. Okay, so until we achieve a 12% return annually, we are not going to take any profit sharing from you. Once we have crossed 12%, we will be sharing 20% of the total profits. Okay, so that is the, I'm not getting into the catch up, but I could explain that. In the past, did any risks materialize? How did ArthVeda deal with it? Well, so far no major risks have arisen. We are ready to take the sales risk, which is the market risk, and that risk did arise in Hyderabad over the last several years, and you can see the result of that. The result of that was this 26% IRR, which we realized in GK's Habitat Royal. So we started out selling at 1300 odd rupees per square foot, and we sold the last apartment at around 1800 odd. So the average price we realized was 1700 or 1650. And with that kind of a very, very low price, we were still able to get a 26% IRR. And the project was delayed for 2.5 years. In terms of slow sales, but became slow at that time due to Telangana, etc. And we still realized the 26 model is. So despite all those kind of vagaries of the market, which is what you are facing when you say we are in risky assets. Okay. How long will one have to invest in the fund now in March 2000? You would have to be new projects. Final close happens within 6 months. All the money would have been deployed in 30 odd projects. Okay, and as each project is executed, the money comes back to the fund, and fund immediately returns district. Okay, it doesn't reinvest. Catch up is not like a watermark. The hurdle rate is the watermark, and since we have okay, somebody asked a question on the watermark, so I'm just clarifying on that. Okay. So once you cross 12%, we have given 100% of the money goes back to the fund, to the fund management. And so that at 15%, investors are for 12. Okay, one more question is, in Dream Fund, the remaining price are in big Mumbai, Bangalore, etc. Was in land development only. Investment was in land development, and the whole fund was invested only in the larger tier 1 and tier 2 cities. That's why you see that they are all invested in Bangalore, Mumbai, Hyderabad, and we are well on our way to exiting properly. Okay, as I told you, the valuations are more than twice. And within this year and the next year, we are going to exit. Okay. They are not convertible at the option of the investor, but they are convertible. I mean, since the manager is investment manager is managing, it is convertible at the option of the investment manager. So you will not be issued OFCDs. You will get units of the fund. The fund manager will take a call on when a convertible has to be converted. It is to be converted only in extreme scenarios, and the investment manager will be best placed to take that call. No, they can convert at any point of time. There is no limit to when they can do it. Yeah, are there any more questions? Okay, okay. Watermark explanation, the audio was not clear, it seems. So I'll clarify the watermark again. Hurdle rate is the watermark. So 12% is what has to be achieved. If 12% IRR is not achieved, the AMCs, your fund manager will not make any money. Okay. Only if the 12% watermark is crossed, then the money starts accruing in terms of profit sharing to the fund manager. And let's say when it crosses around 15% or so, then the distribution becomes 80% to the investor and 20% of profits to the fund manager. At 12%, 0 to 12%, 100% of the money goes to the investor. Is that clear? Thanks, Anup. You're welcome. Yeah, Devang, you want to close, or unless there are more questions?
If in case if there are no questions, I think I would like to thank everybody for joining us on this webinar on a Sunday. I know everybody would be, busy with their own social activities, but I think I should thank everybody for taking the time out. And I would like to thank Vikas also for giving us a presentation. In case if there are any further questions which you want to address, maybe post if you go through the presentation or you remember later on, I think you can forward it to Anup or anybody of the Mitras team, and we will revert back on that immediately and solve your questions and queries. So thank you everybody for joining us on this presentation. Thanks everybody. We will close this webinar right now.